Hello. I thought it made sense this quarter to do a video talking about the impact of deferred revenue on our results. So by this quarter, I should of course note that I'm talking about the first quarter of 2017. If you've read the press release, or if you listened to the conference call or read the script afterwards, you would have heard me talk about a $4.8 million impact from deferred revenue. So I wanted to explain that a bit, help you all understand it in a little more detail, and possibly save you from having to track me down through the quarter for a deeper explanation. First, I want to talk about, just to remind and set the stage, how the accounting works for domain names with deferred revenue. When we sell a domain name, we recognize it ratably over the life of the domain name. Typically, take the simplest example, we sell a domain name for $12. We sell it in January. In January, we will recognize $1 of revenue and we will defer $11, recognizing another $1 each month through that year registration. Now, in addition, we also will be prepaying, when the customer pays us $12, we'll be paying the registry fee. Let's imagine that was $9 for the year. So, of course, we'll be recognizing 75 cents in COGS in January, and then each month pulling $1 into revenue, 75 cents into COGS over the life of the registration. Very simple stage setting example. Now, the first thing that complicates this quarter in particular is the way that deferred revenue is treated at an accounting level with transactions. So when a company acquires another company that has a deferred revenue asset on their balance sheet, essentially it gets wiped out and reset to zero. It's a simple way to think about it. So when we bring over that eNom book of business, we don't bring over all of the deferred revenue. That deferred revenue gets reevaluated. And in this case, there was a reduction of about $8 million. Now, that $8 million reduction is an accounting exercise. Obviously, it's taken on by accounting professionals that you pay to do that work. So that $8 million reduction is the total impact, total negative impact that we'll have from the eNom transaction, and that impact will take place overwhelmingly in 2017. Now, what we're essentially doing in the first quarter is we're refilling the balances of that deferred revenue, or refilling into that deferred revenue account. So in January, I'm just going to talk about the $8 million revalued. In January, we're essentially putting that money in, stocking up the balance for the remainder of the year, and pulling out 1/12 of that amount. It's actually closer to 1/13, but I don't want to play with it too much. And in February, when you're doing it, you will be recognizing both the February and the January and pushing the rest out. Now, over a year, that washes out. As you can see, in January, it's going to have the biggest impact, because in January, you're only pulling in the 1 month and deferring the 11. By the time that same thing is happening in December, you've got all those previous months where you've already stocked your deferral asset that you're pulling out into. So the impact is by far the biggest in Q1. Now, the second thing that complicates it is what's called purchase price accounting. I don't purport to explain it, but it is a one-time charge in the amount of $1.4 million that again takes place in Q1 and is part of the $8 million. That we are allowed at an SEC level to talk about in relation to EBITDA. The rest of it The other 3.4 million in the corner were not, because of the third complication. In May of 2016, the SEC changed the way that they advised companies to talk about adjusted EBITDA. So in particular, the SEC was concerned that companies who sold a subscription service were, in their adjusted EBITDA calculations, treating their sales as if they were the sales of a product. Now, typically when you have a subscription service, you recognize the revenue ratably over the period of the subscription. You know from what I've said above that that's what happens with domain names. But unlike most subscriptions, with a domain name, once you pay up front, there is no right of return, and the bulk of that work is done on our part right at the time we sell the domain name. Put that aside because we're not debating the accounting treatment, we're just trying to understand it a little bit better. But because of that concern of the SEC's about subscription services being treated like products, they changed their approach, and they strongly advised companies that they should not bring deferred revenue amounts into adjusted EBITDA calculations. We had always included the amount of net deferred revenue in our adjusted EBITDA calculations. We did that through Q1 of 2016. When this change was made, we talked about it, and we went along with the change and reported on the basis of the new standard. Now, because OpenSRS is a very large, very mature, relatively slow-growing business, that change didn't really have a material impact on our adjusted EBITDA. It might have had a couple few $100,000 impact per quarter, which we were very comfortable with, and so we just went and complied with the change. But that change now, with the acquisition and with the way that accounting treats deferred revenue when you bring over balances with an acquisition, has a material impact. So the impact of deferred revenue is $4.8 million in the quarter. That on adjusted EBITDA. But that $4.8 million is really an impact on adjusted EBITDA as we reported it under the old approach back in Q1 2016. In Q2 and going forward, with the new approach, only 1.4 million of the 4.8 can we apply to adjusted EBITDA. I know this is becoming convoluted, but I'll ask you to bear with me and maybe watch it a couple times if you need to. The point is that on a cash basis, which is the way we run the business, there's about a 4.8 million difference between the adjusted EBITDA number we report and the way that we have historically, again prior to Q2 of 2016, reported. The total difference for the 2017 will be $8 million, and you'll see that run off. To summarize that impact, I've talked about EBITDA on an apples-to-apples basis going from 2016, $30 million to 2017, $50 million. I've also talked on both the post-transaction in Q1 and Q4 2016 calls about the fact that that $50 million would be impacted by this change in SEC approach and would be more like in the $42 million range. So you want to see the 6.2 million we reported this quarter as relating to the 42. If you wanted to compare it to the 50, you'd add that deferred revenue. And most importantly, that washes out through the year. So in 2018, all of this will have washed through. If we were to assume, and this is just an assumption for strictly expository purposes, this is the furthest thing from guidance. If we were to assume that we grew the business on a cash basis, the way we have historically thought about it, from 2017 to 2018 by 20%, the change in this approach, the new way that the SEC would like us to talk about it, would have us go 30, 42, 60. Using the old approach, 30, 50, 60. Of course, the big difference in 16 to 17 is the ENOM amounts coming in. So I hope that helps you understand both the what and the why. Again, you have the combination of deferred revenue treatment in domain names, purchase price accounting, the way that deferred revenue is treated with acquisitions, and a change in SEC policy, or at least guidance, that really helps or really leads to a somewhat complicated explanation. Thank you.